Financial, the place you come to forge a stronger portfolio. Today, we're putting a real giant through our stress test, NextEra Energy, ticker symbol NEE. Our mission is to tear this company down to the studs, to see if it's built of solid iron or if it's just a house of cards waiting for a strong wind. We're going to find out what's really under the hood. So let's get into it.
Okay, let's just cut right to the chase, shall we? The number one question for anyone even thinking about buying NextEra is this: what on earth are you actually buying here? Everyone tells you utility stocks are supposed to be the safe, even boring part of your portfolio. They're the slow, steady dividend payers you're supposed to buy and forget about. But then you look at NextEra, and all you hear are these whispers: AI, massive renewable projects, partnerships with tech giants. So what is it? Are we looking at a sleepy old power company? Or is this a high-growth tech behemoth just wearing a utilities costume? Because those are two completely different investments with two wildly different risk profiles. And frankly, I get really skeptical when a company tries to be everything to everyone.
And look, this right here, this says it all. This visualizes the whole conflict perfectly. On the left, you've got the picture that comes to mind for every utility on the planet: boring old power lines at sunset. It's stable, it's regulated, it's predictable. I mean, that picture practically screams slow, reliable dividends. But then you look at the right, and you see this sprawling, futuristic, high-tech solar farm that stretches out as far as the eye can see. This is the future. This is the growth story. This is the stuff that gets all the headlines. These two pictures, they represent two completely different business models, two totally different stories they're trying to sell you. So the question is, which one is the real NextEra Energy? Or are they just trying to have their cake and eat it too? And if they are, can they actually pull it off without one side completely undermining the other?
That is the exact conflict we are here to resolve. And to do that right, we need a blueprint. So here's our plan of attack. This is how we're going to deconstruct this company piece by piece. First, we'll hit that core question head on. Is it a utility in disguise? Second, we're going to pressure test what they claim is their unbreakable foundation, Florida Power and Light. Third, we're going to pop the hood on the so-called clean energy engine, NextEra Energy Resources, and see if it's really firing on all cylinders. Fourth, we're going to dissect the AI wildcard, that big partnership with Google. And finally, we will deliver the iron financial verdict. Let's get to work.
All right, let's start with the bedrock. Any structure that's built to last needs a solid foundation. And for NextEra, that is supposed to be Florida Power and Light, or FPL. This is the core business. This is the regulated utility. This is where those predictable, stable cash flows are supposed to come from, day in and day out. We have to examine this foundation for any cracks, any weakness at all, before we even think about looking at the flashier, more exciting parts of the company. Because let me be clear, if this part isn't rock solid, the entire investment thesis just crumbles into dust.
And let's be crystal clear here. On the surface, FPL is exactly what you think it is. It's a classic state-regulated monopoly that generate and deliver power to most of Florida. A state, by the way, with absolutely massive population growth. And in exchange for that, the state basically tells them how much profit they're allowed to make. It is the textbook definition of a boring business. But, and this is a huge but, here's the catch. The sheer scale of what they're doing is anything but typical. The numbers connected to this boring utility are absolutely staggering, and it's that ambition that separates it from just about every other power company out there. Let's put a hard number on that ambition, just so you can feel the weight of it. $100 billion. That's not a typo. That is the capital investment plan for FPL alone through the year 2032. Now, this isn't some speculative tech spending on software or marketing. No, this is steel in the ground, heavy-duty, real-world construction. We're talking about building new power plants, completely modernizing the grid to make it smarter, and hardening every single inch of it against hurricanes. This is a massive, decade-long build-out, and it forms the absolute basis for their earnings growth for the foreseeable future.
So how do they actually make money on that $100 billion spend? Well, that brings us to this incredibly important number. 10.95%. This is their allowed midpoint return on equity, or ROE, and it was unanimously approved in their latest rate agreement with the state of Florida. Now, for anyone who's new to investing in utilities, this is the whole game. The government is essentially guaranteeing them a profit margin on the capital they invest. Every single $1 billion they spend as part of that $100 billion plan has a state-approved profit target attached right to it. And an almost 11% ROE, that is a very, very solid return for a low-risk, regulated business. It provides a level of earnings visibility that, frankly, most companies in the S&P 500 can only dream of.
And this right here is the result of that powerful model. Over $5 billion in pure net profit for the year 2025 coming from FPL alone.
This is the cash flow engine. This is what funds the dividends, pays down the debt, and provides all the capital for those more ambitious growth projects we're going to talk about later. This bedrock isn't just stable, it's immensely, incredibly profitable.
Now here's where it gets really interesting. This foundation isn't just sitting there being stable, it's actually getting stronger. Look at the numbers. Net income jumped from $4.5 billion in 2024 to over $5 billion in 2025. That's solid. But the crucial line for us as shareholders is the earnings per share. You can see it grew from $2.21 all the way up to $2.42. You know what that is? That is nearly 10% year-over-year growth. For the boring, safe part of a business to be compounding earnings at a rate that most growth stocks would kill for, well, that tells you something incredibly powerful. The verdict on the foundation, it's not just solid, it is rock solid.
Okay, the foundation is solid, I'll give you that. FPL is basically a cash printing machine in a state that's growing like a weed. But let's be honest, nobody buys NextEra just for FPL. They buy it for the growth story. And that brings us to the other, more exciting half of the company, NextEra Energy Resources, or NEE. This is the unregulated side. This is the clean energy development arm. This is where they build those massive solar farms and wind turbines. But this is also where all the risk is. So the question becomes, is this stable foundation just a launchpad for something much more dynamic and potentially a lot more volatile? Is this where the real power and the real risk actually lies?
You know, the company's own words set the stage here perfectly. I'm pulling this quote directly from their earnings call. Record year of new generation and storage origination at Energy Resources. They are telling the market in no uncertain terms that this segment is absolutely firing on all cylinders. This isn't some little side project, this is their high-octane growth engine, and they have their foot pressed firmly to the floor. This is the part of the business that's supposed to deliver that outsized growth that separates NEE from all of its sleepy utility peers.
And here is the raw horsepower behind that engine. In 2025 alone, just 1 year, NEE added 13.5 gigawatts of new projects to its development backlog. Now, to make that number real for you, 1 gigawatt is enough electricity to power roughly 750,000 homes. So in a single year, they added a potential to power over 10 million households. The scale is almost incomprehensible. This backlog represents billions and billions in future construction, and more importantly, future earnings, all of which is completely separate from that regulated FPL business.
Now, let's take a closer look at what's actually in that backlog, because the composition here is absolutely critical. As you'd expect, traditional renewables, think solar and wind, make up the biggest piece of the pie, at 60%. But here's what's really interesting. Look at that second bar, battery storage. It now represents nearly a third of their entire backlog, and the company states very explicitly that it's the fastest growing part of their business. This is so crucial. It shows they aren't just building generation, they're building the infrastructure needed to solve the biggest problem with renewables, the intermittency problem, the fact that the sun doesn't always shine and the wind doesn't always blow. This is a much more sophisticated and potentially much more profitable business model.
Whoa, hold on a second. We've all heard the green energy sermon, right? We've seen the glossy pictures of solar panels stretching into the sunset. It all sounds fantastic. But I have to interrupt this perfect clean energy narrative with a very pointed question, and it's based on the company's own actions. We've been talking about this clean energy engine, but is that engine really running on clean fuel? Or is there some dirtier fossil fuel being mixed in that they don't really like to talk about on the front page of their annual report? Because their recent acquisitions tell a very, very different story.
This slide right here lays out the contradiction in plain sight. On the left, you've got the image they want you to see, the clean, shiny future of battery storage. This is their ESG-friendly high-tech story for Wall Street. But on the right, you have the cold, hard reality of their recent investments, a natural gas plant. And this isn't some old asset they're about to retire. This represents a strategic direction they are actively pursuing. They are aggressively investing in new fossil fuel infrastructure at the exact same time they are marketing themselves as the world's clean energy leader. It just doesn't add up.
And look, this isn't just one plant we're talking about. Let's look at the facts. In January, they acquired a significant stake in the Mountain Valley Pipeline, which is a major natural gas pipeline. In the very same month, they closed the acquisition of a company called Symmetry Energy Solutions, which they themselves describe as one of the leading suppliers of natural gas in the U.S. Now, the company will tell you this is all just part of a transition strategy, that natural gas is a bridge fuel that's needed for grid stability when the sun isn't shining. And okay, that's the argument. But when you are buying up major pipelines and top-tier gas suppliers, it starts to look less like a temporary bridge and a lot more like a permanent parallel highway. It seriously complicates the clean energy narrative and forces you to ask, is NEE just another diversified energy conglomerate and not the pure-play renewables champion it pretends to be? These look like real cracks in the clean energy armor to me.
That's a fair challenge, a very fair challenge, and it really does highlight the incredible complexity of this energy transition. But let's pivot now to the most forward-looking and, let's be honest, maybe the most controversial part of their entire story, the AI wildcard. This is where the narrative shifts dramatically from a traditional energy company to something else entirely. The question we have to answer here is whether this is just a bunch of corporate buzzword bingo designed to pump up the stock price, or if it's a genuine high-tech turbocharger that could fundamentally change their growth trajectory and their valuation for years to come.
Now, this isn't just some small internal project they're working on. NextEra has entered into a major strategic partnership with Google Cloud under an initiative they're calling Rewire. And look, when a company the size of NextEra teams up with a tech titan like Google, you have to sit up and pay attention. Their stated goal is to use AI to modernize not just their own operations, but the entire energy sector. This is a massive ambition. It goes way beyond just building power plants. They're trying to position themselves as the core technology provider for the grid of the future.
Okay. Let's translate that corporate speak into language that investors actually understand. The key phrase you need to hear from their announcement is SaaS revenue. SaaS stands for Software as a Service. Just think of your Netflix subscription or your company's Salesforce subscription. It's a recurring, predictable, and, most importantly, high-margin revenue stream. For a utility company, a business that is literally built on steel, concrete, and regulatory filings, to start talking about SaaS revenue is extremely unusual. Now, the potential is enormous. Software margins can be 80–90%, infinitely higher than utility margins. But the billion-dollar question is it real? Can a power company truly transform its corporate DNA to build and sell software effectively, or is this just jargon sprinkled into a press release to try and attract a different class of investor? The execution risk here is just immense.
While they've clearly anticipated that skepticism because they laid out a surprisingly detailed go-to-market blueprint, it's a three-step plan. Step 1 is enhance. They're going to use Google's expertise to improve the AI tools NextEra already uses internally to optimize its own massive grid. Step 2 is transform. They're going to go after the biggest energy consumers on the planet right now, data centers, and use their combined expertise to accelerate infrastructure buildouts for the AI boom. And then step 3 is accelerate. They will jointly create and then sell brand new software products to other utilities and grid operators. You see, this isn't just a vague idea. It's a structured, deliberate plan to create an entirely new, high-margin business line from scratch. And crucially, they made sure to point out that NextEra owns 100% of the intellectual property. All right, we've pressure-tested the unbreakable foundation. We've inspected the high-powered clean energy engine. And yeah, we found some conflicting fuel sources. We've dissected the AI wildcard. Now it's time to bring all the pieces together. It is time for the iron financial verdict. After running this company through our ringer, our stress test, have we found a generational opportunity to build a portfolio around, or is this just a cleverly disguised trap?
Okay, let's lay it all out on the table. The bull case, my case, it's built on 4 solid pillars. First, that unbreakable FPL foundation, which we've seen isn't just stable, it's growing at a tech-like clip. Second, the absolutely massive renewables backlog in NER, especially in battery storage, which promises years and years of secular growth. Third, you have the huge AI growth optionality with Google, a true wildcard that could completely re-rate the company's margin profile. And finally, you have a long, proven history of excellent execution. These guys deliver on what they promise. But the bear case is just as compelling, you have to admit it. First, you've got a conflicted, confusing green strategy. Are they a clean energy leader or are they a natural gas company? It's a totally legitimate question. Second, there is massive execution risk on that $100 billion CapEx plan. Any significant delays or cost overruns could be a disaster for the stock. Third, is the AI hype even real? There is zero revenue from that today. It is all promises and press releases. And finally, you are paying a premium valuation for all of this. This stock is not cheap compared to other utilities, so it has to execute absolutely perfectly on all these grand promises, leaving absolutely no room for error.
And that brings us to the final, crucial question that you, the investor, have to answer for yourself. This really encapsulates the entire conflict. With their feet planted so firmly in the world of regulated utilities and natural gas, while at the same time reaching for this futuristic world of renewables and AI, is NextEra simply building a more complex, more conflicted version of the power grid of the past? Or Are they using their stable, ironclad foundation to finance the construction of the true energy and technology platform of the future? That is the multi-billion-dollar question. And the answer is going to determine if this company forges a path to new highs or if it simply cracks under the immense weight of its own ambition.